SCHD, one of the most popular ETFs among dividend investors, is up 20% year to date. This is beating the S&P 500 by a wide margin, which is only up 8% in 2026. SCHD, the fund everyone called dead money after years of lagging the broader market, is finally winning again. And to be fair, this is a dividend ETF, so part of your return is coming from that 3 to 4% dividend yield, and those dividends have grown at a high rate over time. But even if we look at the total return for SCHD, assuming that you're reinvesting the dividends you earn, the total return over the past 5 years is 57.16%, which is a 9.47% compound annual growth rate. That is still lagging the S&P 500 by a good bit in that time, which is up 79.79% or a 12.45% compound annual growth rate. So what is the real story with SCHD being up and winning so far in 2026? 8 months ago, I made a video asking whether SCHD is broken, and I was diving into my thoughts on the ETF at the time. And despite what you may think from the thumbnail, I was not necessarily sounding the alarm bells. I was just emphasizing that SCHD was doing exactly what you would expect the ETF to be doing at that time. What's been driving up the market over the long term has been the big tech companies. And if you look at the S&P 500, it's 38.6% technology, where if you had looked at SCHD at that time, it was 19.65% energy, 18.5% consumer defensive, and technology, it was under 10% of the fund. I also outlined the potential scenario where it could outperform the S&P 500, and that would be if the big tech stocks sold off. Whether Nvidia, Apple, Microsoft, Amazon, Google, Broadcom, Meta, Tesla, if those companies underperformed, then there is a scenario where SCHD could outperform. And that actually ended up playing out, but even more in favor of SCHD. At that time, back in 2025, the price of oil was very low. At SCHD, they owned a ton of energy stocks, and specifically the oil producers that are highly impacted by the commodity price of oil. And at that time, there were no signs the price was going to increase. But in early 2026, what do you know happened? The Iran war. The price of oil surged, and all energy stocks went up a ton. That ended up being the perfect scenario for an SCHD fund, which was 20% energy. There was also a big flight to safety at that time, with consumer defensive going up and the more reliable side of healthcare and industrials going up as well. And on the tech side of things, you've seen some weakness. Microsoft is down 20% year to date. Meta is down 8.4% year to date. Google is basically flat year to date. Amazon's up 2.48% year to date. Nvidia is only up 9.5% year to date. So when you look at this, the outperformance of SCHD so far in 2026, it makes a lot of sense. And the other factor I mentioned in that video about why SCHD wasn't broken is the fact that it continues to be a strong dividend payer. And it sits in the market as a very simple solution for an investor that doesn't want to spend a ton of time researching stocks to find an option that's safe and has a slightly higher yield than the S&P 500 and the broader market. You can get closer to a 3 to 4% yield compared to a 1% yield. And since inception, SCHD has pretty good total returns. It's up 500% since it was created back in 2011. This is assuming your dividends have been reinvested the whole time. That'd be a 12.91% CAGR. 200% of that return is from the dividend reinvestment. That goes to show the long-term compounding of reinvesting dividends. And if we go and look at the S&P 500 over that same time period, that has a total return of 645% or a 14.59% CAGR. So over the long run, SCHD has underperformed the broader market. And as we sit here today with it outperforming in 2026, the question is whether now is a great time to buy SCHD. And that's the question I'm going to be answering in this video. I'm going to be taking a look at the new diversification as the fund has updated over time and its allocation is slightly different than it was last year. I'm going to be taking a look at the dividend growth of SCHD and what the dividend yield of the stock says about its valuation and whether or not it's a good time to buy. And I'm going to give my thoughts on whether I think the S&P 500 will outperform in the second half of the year and in the years to come. If you want to follow along at home and research stocks the same way I do, all of this is available at dividenddata.com. This is my stock research tool. We just launched our next generation version of the product and it's like 10x better. And to celebrate the launch, we're doing a 50% off sale where you can lock in half off annual membership and keep that discounted price for life. The link is in the description and pinned comment of the video. And with that said, let's roll the intro and get into today's SCHD video.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. So let's just start with an overview of SCHD, and I'll dive into all of the important metrics like their expense ratio, their dividend, their diversification. So as I'm making this video, the current share price is $33.29. And this gives the company a dividend yield of 3.03%. That's on a forward-looking basis, but it's a little underestimating. And if we go to the dividend tab, you can see why. SCHD, they're a little bit of a weird fund, how every payment's not consistent, it's variable. So it's basing the forward-looking dividend on this most recent one. But you can see the trailing 12-month dividend yield is 3.15%. And we'll dive more specifically into this dividend because there's some concerning things about potential slowing growth for SCHD. And the dividend's a large part of the reason why people buy the ETF. But big picture on SCHD, it's one of the more popular dividend-focused ETFs. It has $102 billion in assets under management. This is a Schwab ETF. It's diversified with 100 holdings. And one of the reasons why people love this ETF is that it's a low-fee vehicle. It has a 0.06% expense ratio. This makes it a very low fee option, especially relative to its peers. This means if you have 1,000 shares of SCHD, you only pay an annual fee of $19.97. And like the way how investments compound, fees also compound over time. So you do want to be careful about not getting into high fee investment vehicles. Now diving in more specifically to the dividend payment for SCHD, they pay quarterly. And if we look at it on a long-term basis, the dividend has grown a lot. In fact, it has grown at a 9.1% compound annual growth rate. However, this is slowing. Over the past 5 years, it's grown at a 7% CAGR. Over the past 3 years, 4.45%, so it's getting slower in terms of dividend growth. And as we sit today, it's actually down year over year. This most recent dividend payment, it's down compared to the one of that time period last year. And as we use some of our tools over at dividenddata.com, right now we're forecasting around 2.2% compound annual growth rate for dividend growth. So this is a potential warning to watch out for SCHD investors. Another thing to focus on is the dividend yield. And that's one metric you could get an idea of the potential valuation of the SCHD ETF if you're trying to optimize your yield buying point. Now, since it's a variable payment, as I mentioned earlier, we want to use the trailing 12 months version of the yield. That makes it much more smooth, as you can see. And this is what we call the yield analyzer chart. And it lets you know basically when over the selected time period, you can see the daily dividend yield over time, and you can get an idea of what percentile it's at right now compared to its historical yields. And right now we're definitely at the lower end. Now we're not all the way below that 10th percentile. There was a period in 2021 and 2022 when this was a 2.75% dividend yield, but purely in terms of optimizing your dividend yield that you're buying at, it was in the 4% for quite a bit in 2025. And it peaked at 4.27%. So ironically, because SCHD has done so well in terms of its price in 2026, the dividend growth hasn't been following it up. So that yield is coming down. And if you're buying more shares right now, you're getting less dividend for all the money you're putting in, at least over the short term. Dividend growth could make that up in the long run. But ETFs, they're a difficult thing to value, so this is just kind of a useful proxy, the dividend yield. And let's say you were targeting a 3.5% dividend yield for SCHD, you would need the share price to go down 13% for that to make sense. But of course, dividend's only part of it. It's about the actual businesses you own as well. And SCHD, it's very diversified, and it's still a very different makeup compared to the S&P 500. Let's go down and let's start with the sector allocation. And this has shifted. As I mentioned, last year it was dominant in energy, and that helped it a ton in early 2026. But as we sit here right now, I think a lot of these energy stocks are on the overvalued side, especially if oil prices continue coming down. So energy being down to the third largest at 14.13%, that's a good help for them. Healthcare is now the highest at 20.77%. Consumer defensive number 2 at 20.6%. Technology is higher now at 12.7%. Financials at 9.9%. Industrials at 7.7%. So it is still very diversified and definitely different than the S&P 500. But what are the actual stocks that make up the fund? Because that's what makes the big difference over the long run. That's the thing that really matters. You have Abbott Laboratories, ticker symbol ABT, Merck, ticker symbol MRK, United Health Group, ticker symbol UNH, Amgen, ticker symbol AMGN. And now one thing I will say about the 4 of these is that they're arguably kind of on the undervalued side. Now, I'm not a healthcare investor. I don't really follow that space that well. But UNH, it was a great compounder over the long run, had that huge sell-off last year, and it's still at a pretty cheap price compared to historic multiples. If we look at the yield analyzer and on the all-time for UNH, it is still in that deep value territory, 94th percentile all time. Now, if we zoom back into over the past 5 years, it was really beaten down, and it was for about a year. So we have come down a bit from those cheap prices. Abbott's not trading at all-time highs either. An 18.7 forward-looking P ratio, that's not ridiculous. You can see analysts are expecting around 10% annual earnings per share growth. That would give it a 2030 P ratio of 12.4 based on today's price. So not ridiculous. And a lot of these other holdings, they're the dividend kings and dividend aristocrats that you already know about. Procter & Gamble, ticker symbol PG, Home Depot, ticker symbol HD, Coca-Cola, ticker symbol KO, Chevron, ticker symbol CVX, ConocoPhillips, COP, PepsiCo, ticker symbol PEP. And you can scroll down and see the full list of all of the different options and what they own, the weights of each holding. And surprise, surprise, it's a bunch of dividend stocks. So overall, when I'm looking at SCHD stock, there's nothing I'm necessarily worried about. And I think as long as you're aware that over the long run, you might slightly underperform in terms of total return, but along the way, you'll have some pretty reliable dividend income at a slightly higher yield. You might see a little bit less volatility in the share price of the ETF. But personally, I am much more of a tech-focused investor. And when I look at the S&P 500, I personally think that it's going to outperform in the back half of the year and in the years to come. And I think a lot of the big tech companies right now, they're at pretty attractive valuations, if I'm being honest, and they are growing their actual fundamentals at a much higher rate. Whether it's Microsoft, whether it's Amazon, whether it's Google, whether it's Meta. Heck, I think even NVIDIA is looking quite attractive, and their growth is still off the charts in terms of their earnings per share. It's grown 80% year over year. And I think purely when I'm looking at the actual holdings of the S&P 500, I feel much more confident in the growth in the years to come compared to SCHD. But that's just my personal opinion. With that said, if you enjoyed the video, make sure to leave a like, comment, and subscribe to the channel. And if you want to use this stock research tool I have throughout, it's all available at dividenddata.com. I have the link in the description in order for you to open up this SCHD fund page on our website. You can try that out for free. And overall, dividenddata.com is packed with features. It's gotten like 10 times better. We just relaunched it last week. I've been working on this in stealth for months, and I am so excited to bring it all to you guys. The early feedback has been amazing. And if you want to be a founding member of the new tool, we have a 50% off offer where you can lock in that discounted price on the annual membership. And it's really the best way to support what we do in the channel. With that said, happy investing, and I'll see you in the next video.